Welcome back, everybody. So, one thing I was looking into recently was the portfolios of super investors. And specifically, I wanted to see if there were any companies or types of companies for that matter that a disproportionately large number of super investors owned. And when you take a look at the list of stocks that are most commonly owned among the notable fund managers like your Warren Buffett's, Bill Ackman's, Monish Pabrai's, you see some pretty common names at the top of the list. For example, the most commonly owned stock among the super investors is Google by quite a lot, actually. 32 out of the 70 super investors that I track on my website here currently have Google in their portfolio, which is almost half of them. And the second most commonly owned stock is Microsoft, which only has 20. And I think you see a pretty common theme among the top stocks. You see most of the big tech stocks like Meta, Amazon, Apple. You also have Berkshire Hathaway and the payment processing duopoly of Visa and MasterCard. But then there's one company that's much smaller than the others. It's not a big tech company, and many super investors own it, and that company is Moody's. Now, I'm pretty sure most of you have heard of Moody's before. They are the world's leading credit rating service, and they actually do more than just credit ratings. They have a whole other segment called Moody's Analytics, which offers a very broad range of services, ranging from things like financial data, software, risk management services. And this segment has historically been smaller relative to the credit ratings business, but recently it has actually overtook it. So why is it that so many of these investors own Moody's? Well, there's a few reasons for this, and firstly, Moody's is actually a pretty easy business to understand. The credit ratings business charges a debt issuer like a corporation or a government, and then investors and banks use these ratings to assess their riskiness. And that's really all it is at its core. It's a service that is provided to other businesses that is very important for the global markets. And I think truly smart investors are very good at understanding what they don't know and what they can't predict when they are investing. They see uncertainty as the real risk in investing, because if something happens to a company that you invested in that you didn't foresee happening, or maybe you knew about a certain risk but you didn't properly assess it, that could result in a loss that you cannot recover from. And the number one rule in investing is don't lose money. Now, that being said, all investors will lose money at some point. No one is going to have a perfect track record. But with a company like Moody's, there's not very much uncertainty to their business. So the odds that you're going to lose money investing in them are pretty low, and the real risk in investing in them is buying in at too high of a price. And then secondly, the business is a extremely good business. It's consistently profitable. As we can see, they have operating margins usually in the 35 to 45% range, and it doesn't require any reinvestment back in the business to grow because it's mainly a service-based business with demand that naturally increases over time. And if we look at the return on invested capital metric, which is really our best metric for measuring business quality, it's been consistently high. It did have a few below average years more recently because interest rates went up and banks tightened credit. So there wasn't as much lending activity in the economy as before. But recently, the Federal Reserve has began signaling that rate cuts will keep coming. So investors now believe we're at the beginning of a credit loosening cycle, which does benefit Moody's business. And thirdly, not only is it a high quality business, but it has a very strong economic moat, arguably one of the strongest moats in the entire US market. The Moody's brand carries a lot of weight. It's been around for over 100 years with a long established track record of providing credit ratings, which gives it the confidence of institutions and investors around the world. And their primary customers are companies who are looking to issue debt to finance a business expansion. And these companies know that a high credit rating from Moody's will reduce their borrowing costs, which can save them millions in interest payments over the duration of that loan. So they basically have this self-reinforcing value creation cycle to their business. So the growth of the Moody's business is tied to the level of debt issuance within the economy. As we can see, their best year was in 2021 when interest rates were zero, and the years following haven't been as good since rates have been higher. So there is a somewhat cyclical nature to their business. And since the size of debt issues generally increase over time because of things like inflation and just overall growth in economic activity around the world, the demand for their services will always be there and it will always be increasing. They also hold a pretty dominant market share. Moody's accounts for about 40 to 45% of all debt ratings in the Western economy. The other two biggest players are S&P, which has a similar market share and is also well represented in super investor portfolios with 7 of them owning it, which remember Moody's has 12 owners, and Fitch is the other one, which has a much smaller market share. And these three companies together are essentially a toll booth for the credit markets around the world. And this market is also virtually a immune to disruption. In order for a company to provide credit ratings, they must be a nationally recognized statistical rating organization, or NRSRO, which is a designation that's given by the SEC. So this creates this natural barrier to entry because if there's a new company that wants to obtain this designation, they have rigorous standards around governance, conflicts of interest, and transparency around their rating methodologies. So it's a very difficult thing to do, and there's typically not many new companies that get this designation. And that's even before considering the fact that you also have to gain the trust of the financial markets for companies to actually want to use your service. And in doing that, you'd be competing against other ratings agencies that have been around for over 100 years and already have a long established track record. So the regulatory environment that they're in protects them from competition, but the prices that they can charge to their customers are not regulated, which is a pretty interesting setup for a company if you think about it. Because if you think of a business like a utility company basically has a local monopoly over the area that they service. But the prices that they can charge their customers are also regulated. So you can almost think of Moody's as if it's a unregulated utility company. So this all sounds great. The business is obviously very good, but what about the valuation? Moody's is currently trading at what looks like an expensive multiple. Right now, it's valued at a PE ratio in the mid 40s, which is historically quite high for them. And since May of this year, the stock overall is up about 25%. So it has gone up a lot recently. And part of the reason for this is something that I briefly touched on earlier in this video, which is the Federal Reserve has begun signaling that they're going to start cutting rates this year. And lower rates means more lending activity will start to pick back up, which is obviously good for Moody's credit ratings business. So does Moody's still make sense even at this historically high price? Now there's this quote by Charlie Munger, which I think applies to this situation really well, which is over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital for over 40 years and you hold it for those 40 years, you're not going to earn much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with a fine result. And this has more or less held true with Moody's. They've had roughly 25% compounded returns over the past 10 plus years, and return on invested capital has been around 25%. But this period also saw the PE multiple expand from about 15 back in 2012 to where it sits now at 45, which of course has also boosted returns. Now, I don't necessarily think that this PE ratio is too high for Moody's, and there's a few reasons for that. One is back in the early 2010s, it wasn't that long after the financial crisis, and Moody's was under a lot of regulatory scrutiny for their role in that financial crisis. They even had to pay a 800 million fine back in 2017. So their PE ratio back then reflected this uncertainty, but this isn't really the case with them anymore. Also, the Moody's Analytics business has grown substantially over the past decade, and this business is less cyclical than the credit rating business. As we can see, it's been consistently growing about 13% annually, and the growth rate is much more stable than the credit rating business. So growth of this segment is now being priced in as well, which has led to a higher multiple over the years. And then also the Moody's moat has only gotten stronger over time, and companies that have expanding economic moats will usually also see their PE ratios continually climb until they give investors a reason to think otherwise. Costco is another great example of this. Their PE multiple has expanded significantly over the years. We can even look at companies like Visa, which is a similar pattern, although not quite as linear as Costco. And Microsoft is another example. Higher quality businesses with strong moats just have more long-term value than normal businesses do. And as the moats get deeper, their valuation multiples usually will expand. So personally, I think it is worth paying up for a better, higher quality business. You're not going to get 100% returns in 1 year with this type of strategy, but if you can even get, say, 15% annual returns instead of 10% over a long enough time frame, that ends up making a huge difference. So overall, what can we learn from this? Well, for one, super investors love economic moats. Pretty much all of the most commonly owned companies by notable super investors have some type of economic moat. And number two, companies with a regulatory advantage that also have organic growth plus operating leverage in their businesses. They use the cash that they generate to return to shareholders via buybacks and dividends. are great businesses and will always trade at what looks like a high multiple. And the high multiple doesn't necessarily make it too expensive. Companies that have cheap multiples have that because investors don't know if that company will be able to survive for the next 10 or even 20 years. Capitalism is a brutal game, but a company like Moody's will probably still be around even 100 years from now. So anyways, guys, that does it for this video. I hope you did enjoy it. Also, if you're interested in seeing the most up-to-date list of stocks that super investors own that I showed throughout this video, you can do that on my website. Just go to tickernomics.com, which I have linked in the description, and then go to public scripts and search for a script called Super Investor Stocks, and then just click the run button and it will show you the list.